You check your bank account on the 25th. The balance is $43. Then a coffee you bought 3 days ago finally clears, and now you're negative. $35 gone, just for being poor at the wrong moment. Somewhere else right now, someone with $25 million is on a call with their banker, who is asking if they'd like to borrow $2 million against their portfolio at a rate lower than what you're paying on that overdraft. Same industry, same word, banking. Two completely different worlds. This isn't about how much you earn. It's about which tier of the system you've been sorted into, and the bank decided your tier before you ever walked in. Here's the part nobody explains. Banks don't have one relationship with money. They have 5 or 6, stacked like floors in a building. And the fees, the perks, the interest rates, even how fast someone answers your call, all of it changes the moment you cross an invisible net worth line. Let's start at floor 0. At $0 or close to it, your bank makes money by charging you to keep money there. The Consumer Financial Protection Bureau, the federal agency that studies exactly this, has tracked how overdraft and insufficient funds fees function inside U.S. banks. Their research found something blunt. These fees are concentrated overwhelmingly on a small slice of low-balance accounts, and those same customers get charged repeatedly, sometimes dozens of times a year. One missed timing on a $6 purchase can trigger a $35 penalty. That's not a rounding error. That's the business model at this floor. Researchers have a name for this pattern, the poverty premium. It shows up everywhere, not just overdrafts. Check cashing counters that take a cut just to hand you your own paycheck in cash. Payday loans priced at rates that would be illegal if a bank charged them on a mortgage. Minimum balance requirements that quietly convert your free checking account into a monthly fee the moment your balance dips for even a day. None of this happens to the account above you. It happens because the account above you has a buffer, and yours doesn't. And a buffer, it turns out, is the single most expensive thing you can not have. Now move up. At $10,000 to maybe $50,000 in the bank, the fees start softening. You can often waive them with a minimum balance or a paycheck on direct deposit. You're no longer a target. You're just invisible. Standard checking, standard savings. A debit card, an app. Nobody calls you. Nobody's optimizing anything for you. You are the median. Somewhere around $100,000 to $250,000 in assets, not just cash, but investments held at the bank. Something shifts. This is roughly where premier or preferred tiers kick in at most major U.S. banks. Chase Private Client, for example, has historically opened its doors around $150,000 in combined deposits and investments. Suddenly your checking is free, your wire transfers are free, and you get a phone number that isn't a call center. You haven't done anything different. You just crossed a line the bank drew for you, and on the other side of that line, the bank starts calling you first, inviting you in, instead of waiting for you to complain. At $1 million, you enter what the industry actually calls private banking, a term borrowed straight from Brooke Harrington's research on the profession. Harrington, a sociologist who spent years training as a wealth manager to study the industry from the inside, documented how private banking exists specifically to manage, shelter, and grow more money for people who already have enough of it that losing a little to fees would be an insult. Picture the scene. Instead of a hold notice on your account, you get a call asking whether you'd like to lock in a lower rate on a line of credit secured against your portfolio. No need to sell anything. At this tier you get a dedicated banker, discounted lending, and, this is the part that stings, access to credit lines priced lower than what you paid on your overdraft back at floor 0. The bank isn't charging you to hold your money anymore. It's competing to lend you more of it. Push further, to $10 million, and you stop dealing with private banking altogether. Now it's wealth management proper, tax structuring, trust and estate planning. Sometimes an entire team assigned only to you. Bank of America's private bank and J.P. Morgan's private bank have both historically set entry points somewhere in this range. Other institutions cluster nearby, each one quietly competing for the same few thousand households. This is where money stops being cash in an account and starts being a portfolio engineered to avoid unnecessary taxes, unnecessary risk, and unnecessary attention. At $25 million, you're inside what's sometimes called the family office threshold, the point where some families stop using a bank's wealth division at all and instead hire a private team whose only client is them. Lending here gets creative. Loans collateralized by art hanging on the wall, by shares in a private company that hasn't gone public, by a future inheritance that hasn't even arrived yet. The Federal Reserve's Survey of Consumer Finances, the government's main tool for tracking how wealth concentrates in America, shows that assets like these are held almost exclusively at the very top of the distribution, which is exactly why the products built around them only exist up there. Nobody at floor zero is ever offered a loan against a painting. It's worth remembering what happened the last time this whole system nearly broke. During the 2008 financial crisis, banks that had made reckless bets were bailed out by the government within weeks, while ordinary homeowners, many of them on the lower floors of this same building, spent years fighting foreclosure, watching the value of the one asset they did have collapse. The rules that protected the institutions at the top were not the rules applied to the households at the bottom. That gap didn't close after the crisis. It became the blueprint for how the system still runs today. Now here's the twist, and it's the one that should actually bother you. At every floor below private banking, the bank profits by charging you for access, overdraft fees, maintenance fees, ATM fees, the $30 penalty for a coffee. Above that line, the bank profits by lending to you cheaply, because your collateral is enormous and your risk of default is close to zero. In other words, the system charges the person with the least room for error the most and charges the person with the most room for error the least. It's not a coincidence. It's just how risk-based pricing behaves when it gets applied to human beings instead of spreadsheets. But, and this matters, Thomas Stanley and William Danko's research in The Millionaire Next Door found that a huge share of actual millionaires never look like it and never touch a private banking desk at all. Many live in ordinary houses, drive ordinary cars, and keep their money in unglamorous index funds, quietly crossing these tiers without a banker ever calling. Which tells you something important. The floor you're on is about visible assets sitting at an institution, not about actual wealth. You can be wealthy and invisible to the system, or you can look ordinary and still be stuck on floor zero, paying the $35 fee. Think about what that means for how you actually bank. The fee isn't punishing your spending. It's pricing your buffer, or the lack of one. Someone at the top of the building isn't smarter about coffee purchases than you are. They just have enough collateral sitting still that the bank never needs to ask twice. Every premier tier, every relationship banking perk, every private line of credit is really the same offer repeated at a bigger scale. Keep enough parked here, and we'll stop treating you like a risk. So picture your own account right now, not as a number, but as a floor in that building. Every fee you've ever paid, every rate you've ever been offered, was a message about which floor the bank thinks you're standing on. The system was never really about your income. It's about which floor you're standing on when the bank decides to look at you. And for most people, the fastest way off the bottom floor isn't a bigger paycheck. It's making sure the assets you already have get counted at all, instead of sitting somewhere the bank never sees. You check your bank account on the 25th again. The balance still isn't much. But now you know the $35 fee was never really about the coffee. It was the toll for standing on the wrong floor.